Let's talk options and pricing of options. So this is the lesson where we start to really get into some numbers, and it's going to sound like a lot of stuff coming at you at one time, but don't worry, it all comes clear soon enough. But I got to throw a bunch at you, and then we're going to see what sticks, and then we'll start to work on making it all stick. So we're going to define options and define the pricing of options as we go along through this. But let's start out by doing this. What is an option? Well, an option is the right, but not the obligation, to buy or sell something at a certain price by a certain date. That's all it is. It's just the option to do something. Okay? That's why it's called an option. It's cool that you have options in life, right? And this is one way to do that. Call options. A call option is the buyer believes that the stock is going up. So call up. When you call somebody up, that means you think it's going up. There are something's called put options, and that's if the buyer believes that the stock is going down. You put somebody down. That's how you remember that. You know what? In the cash flow machine trading system, we're not going to really worry about the put options. I mean, there's a place for them to play a role, but it's so far down the road that we're not going to worry about it. 99.5% of everything we do is in calls, and we're going to worry about calls for now, okay? So in the cash flow machine, we are going to focus only on call options. Got that? Cool. All right. Here's the vocabulary we're going to use. You're going to start using this yourself, so you got to know about it. So if I say something like, I want to buy the Apple August 21st, 2020 400 strike price call option, that's how you read that. Now let's explain the different things. Apple is the stock price. Sorry, Apple is the name of the stock. August 21st, 2020 is the expiration date. It's also the name of the option. The Apple August 21st, 2020 is the name of the option. But really, it used to be just symbols. Now they've said, let's put the date in there so everybody knows when the thing expires. So August 21st, 2020 is when this expires. There's a strike price, the price at which you can exercise the option, and that's $400. And of course, it's a call option, which is what we're dealing with, not put options, only call options, okay? So that's what the vocabulary is. Apple, August 21st, $400 strike price, calls. If I just say calls instead of call option, it means the same thing. So, how are options priced? Well, there's a big debate going on, but I'll tell you, a few years ago, some guys won a Nobel Prize for creating this Black-Scholes model. These two guys named Black and Scholes and a few other people got together and they created this model. And it's this crazy formula with logarithms and square roots and all these variables. But the bottom line is what really determines options prices is not some crazy model. It's all the buyers and sellers in the market. Buying and selling, that's what determines the prices. People are interested in buying, the prices go up. People are interested in selling goes down, just like every market in the world. And the buyers and sellers are the institutional buyers and sellers primarily that are moving things. And then there's professional market makers that are in there to make two-sided markets. So they're willing to buy it at the bid and sell it at the offer and make the spread so that you have a liquid market when you want to trade. So the more market makers and the more interest there is in there, the more liquidity is in there, which is good for us as traders. And that all these people coming together, you and the institutions, the market makers, the whole market, everybody together creates what's called the National Best Bid and Offer, NBBO. That's all the participants together, linking all their prices, all their bids and offers, coming to a consolidated screen, which you get to see when you click in your electronic trading system. So at the end of the day, it's not Black-Scholes. It's not any other kind of options pricing model. It's nothing that has to do with that. That might give players an idea of where a stock should go, but at the end of the day, it's really buyers and sellers that are making the market. Remember that. It's nothing really more than that. So at the end of the day, it's not theoretical. It's actual market participants making the price based on supply and demand. Buying and selling between willing buyers and sellers. Like, I don't care what you ask for your house if you want to sell it for $10 million. If it's only worth $5 million and that's all that somebody's willing to pay for it, it doesn't matter if you say $10 million. The market for that is $5 million. So it's a willing buyer and a willing seller coming together to make a transaction that creates the option price. Now, there is a component of a pricing model, which is called implied volatility. That's how much the stock moves, which creates how much the option will move. And all you need to know is that the more volatile a stock is, the more it moves up and down during the day, and the wider the spread is, how much it moves up and down, that's called the volatility. And if that increases, it's deemed to be more volatile. And so implied volatility goes up when a stock has volatility that goes up. And that affects the pricing of the option. People are willing to pay more because there's more risk. All right, so higher volatility leads to an increase in price and an increase, therefore, in risk. Now, the Options Industry Council puts out this thing called an options calculator. It's really cool, and I highly recommend you go to this website, and here's the link, and put in the link, and then you can start to mess around with the prices of options. And let's go do that right now. So here's the options calculator from the Options Industry Council, and I'm putting in Netflix today. The market's closed, and it just closed at $493.16. Now, we'll say that the strike price that expires just 3 days from now, okay, while we're making this video, 3 days from now, is going to be calculated. We hit the calculate button, and we come up with $4.36. Now, whether it's $4.36 or not, that's what the model basically says it is. It's only worth what, if you're willing to buy it for $4.36, then that's what it's worth. But if you're only willing to pay $3.80 and nobody's willing to pay more than that, then that's what the market's going to show. It doesn't matter what this calculator says. But to give you an idea, it's pretty accurate, especially now that the market's closed, it kind of figures some stuff out. And it gets you close, gets you an idea of what it should be selling at, based on this crazy Black-Scholes model that these guys won the prize for. So let's look at this. The price is $493.16, and it's out of the money. The strike price is $500. You'll understand this in a few minutes when I explain it. So it's $7 out of the money. It's only valuable when it becomes over the strike price. But somebody's still willing to buy it and sell it for $4.36, let's say, and I believe that's true. So you got to think about it. Are you willing to spend $4.36 for the right to buy Netflix $7 higher, and it does move around a bit, $7 higher in 3 days? That's the question you have to ask yourself. Are you willing to spend $4 for the stock to have to go up another $7 before you even get in the money? It's got to go up to $504.36 for you to break even. Are you at $493.16? It's got to go up 11 points basically. Are you willing to spend $4 betting that the stock is going to go up by $11? That's the question for you. As the cash flow machine expert, right, that you're going to become, we're not buying those calls. We're selling them. We're willing to sell somebody the right to buy our stock from us at $500, and we're willing to take $4.36 to do that. Now, if the stock goes to $525, we don't get the extra $25. We only get up to $500. But we're willing to sell it, even though it's not even there yet, but we get $4.36. Let's change it and make it in the money. Let's go to $4.90. Go to $4.90, hit the calculate button, give it a second, and it runs its numbers, and it comes up with $8.89. So now you notice this is $3 in the money. The strike is $4.90, but the price of the stock is $4.93. So it's $3.16 in the money. Now, if it's in the money that amount, the option's still valued at $8.89. This option has to go to $498.89 for this buyer to break even. But as the seller in the cash flow machine, you get to accept the whole $8.89, and all you have to do is give up your stock at $4.90. Now the stock's at $4.93, so there's a fairly good chance you're going to do that. What happens if we go to $4.65, $4.60, whatever, $4.60, let's call it. We put it in at $4.60. Now let's look at what happens. The option is trading for $33. But you know what? It's $33 in the money. So there's really no risk, and therefore people aren't willing to pay extra for it like they were willing to do on the out of the money or the close to the monies, right? So hopefully you're starting to see this. I know it may not be clear to you yet. I may just be talking gibberish at this point, and that's okay. It's going to start to come clear. just hang with me, maybe even rewind, watch that again. But I'm going to explain it to you in a different way. I'm going to crack this in a bunch of different ways for you so that you get it. So watch the next part, and we'll see as if this starts to get a little bit clearer. It's going to take a few lessons for it to get clear. It always does. But then once you get it, boom, you got it. The options premium, or the option price as it's called, is something that we're going to be throwing around. The option price of the premium. All right. So if you hear me say premium, it doesn't mean anything other than price. It doesn't mean fancy, or it doesn't mean extra. It just means price. I don't know why they called it that, but it doesn't matter. The price is what the buyer pays. He pays the premium. The seller receives the premium. There's a buyer and seller every transaction. If you're the seller, whenever you sell anything, you take money and you put it in your purse, you put it in your wallet. So I want you to think about that. Actually, you're taking money and putting it in your wallet. When it's in your wallet, it's really hard to get out of your wallet, right? It's a lot easier to keep the money in there than it is for somebody to come and rip it out of your pocket and take it out of there. So I want you to think about it like that. Now, you can trade an option just like you trade a stock. You don't have to exercise the position, and you don't have to hold it till expiration, even though that's the name of the option, like that August 21st. It doesn't mean you have to hold it till August 21st. You could buy it and sell it in the next 10 minutes. So it trades just like a stock. It goes up and down just like the stock and with the stock. And then the premium is quoted on a per share basis. So when you see it priced at something at $10, that just means it's $10 per share. But you have to buy 100 shares when you buy a contract. That's just the minimum. They don't want to be messing around with shares. If you want one share, just go buy the stock. They're saying you have to buy 100 shares or 100 shares worth of an option. So if the contract of an option is trading at $2, the cost is going to be $200, which is 100 shares times $2. Got that? Obviously, if you trade 10 contracts, that's 1,000 shares, and so on. But the contract is always for 100 shares. But we're always going to talk about one single price, okay, the $2, because it's share for share. All right? Now, the intrinsic value and the time value are two key components that make up an options premium or an options price. The intrinsic value is how much in the money the stock is above the strike price. We call that the protection amount in the cash flow machine. In the time premium, what that means is the amount in excess of the intrinsic value. The excess of intrinsic value. So if there's two components that make up a price of an option, intrinsic value and time premium, once you know the intrinsic value, you're going to be able to know the time premium because that's the difference, right? It's the amount in excess of the intrinsic value. So the difference here is there's time decay as it approaches expiration, which we call in the cash flow machine, we call it the juice. We're after the squeezing of the juice in this system. So when an option expires, it only has intrinsic value remaining, okay? It's just the in the money amount that remains. Everything else is gone. All right, let's go to the chalkboard and maybe this will come a little bit clearer to you. Okay, so let's talk about an options pricing. And I'm going to do it with a little bit of visual stuff for you, but hopefully you'll get this quickly. All right, if you're in the options business, you're going to start to see this graph, okay? This is a graph of the price of an option. This is time, and this is price. Just call it price like that, okay? So time and price. This is basically what your value looks like. This is expiration, okay? So generally it's going to keep a value, and then all things being equal, it's going to go down as it approaches expiration. Now, the actual components of a option, a price, a premium, is made up of two real components, okay? One is called in the money amount, okay? And the other one is called time premium. Those are the official names of it. We use, in the cash flow machine system, we use something different. But we're going to call it that just so you can get an understanding of what that means, okay? So these two things make up the price of the option, or the premium, okay? All right, now if you got that, let's look at an example, all right? So here's an example. Let's say there's a stock today trading at $100. Okay, stock's trading at $100. There's a $95 option. Okay, that's the strike price. That expires in a month. Okay, so let's say it's got 30 days left. Okay, and if the stock is trading and it's got 30 days left, why don't we just make an assumption? And this is pretty close. We're gonna say that this is trading for $9. Okay, so it's a $9 premium. Can I just do this from now on, right? Dollar sign. It's a $9 price, okay? So what's the $9? Well, the $9 is made up of these two components, time premium and in the money premium, okay? Time premium and in the money amount. So we take the time premium and we take the in the money to get the whole premium, or the price, okay? So the price of it is, if it's trading at 100 and it's got a $95 strike, that means you can buy it for $95. Therefore, it's $5 in the money. So this amount here is $5, okay? And then the rest of the $9 is made up by the other component, right? X plus Y equals Z. But the other component is the $4 that it's in the money. It's $9 minus the $5 gives us the $4 that's in the money, giving us a total of $9. I hope you see that, okay? Now, we're gonna have to assume that everything stays the same until expiration for 30 days. In 30 days, if the stock is still trading at $100, the value of this is now $5, right? Because it's $5 in the money. $5 minus 95 minus 100 is $5 in the money. But there's no more time left on it. The options expires or is about to expire. It's got no time premium left on it. If you remember this graph, you lose your time premium over time. So the bottom line is that $4 ends up being 0, and you keep the $5 in the money amount, and you end up with $5. Okay? So if you're the buyer of that and you paid $9 and you end up getting back $5, you lose $4. Isn't that right? Okay? But I want you to understand that there's a $4 delta, all other things being the same. If the stock moves up, the in the money amount moves up. If the stock moves down, the in the money amount moves down until there's no in the money amount. Below $95, there's no in the money. At $94.99, there's no in the money at expiration. So you lose both the in the money amount and the time premium, meaning the value is 0. That $4 starts to decline, okay? But things being the same, this is what you get, okay? The important thing to know is this is how it works. Let's go over it again. Time premium plus in the money amount is your price. Now, I use different terms. They're a lot more fun. We're going to stop calling it time premium because that's boring. We're going to start calling it juice. Okay? Juice. And I'll show you why you're going to want to call it juice in just a second. In the money amount is going to be your protection amount. Okay? So your protection amount plus your juice equals your premium on your option. What the heck am I talking about? Well, when you buy this at $9 and you sell it for $5, you lose money. But what if you sold it for $9 and you bought it back? Now you make money. In the cash flow machine, we are the sellers of the options. We're not the buyers of the options. So we flip the whole equation on its ear. So this particular example, the stock's trading at 100, but it closes at 100 at expiration, we end up making $4. Okay? Where does the $4 come from? Well, it doesn't come from the protection amount or the in the money amount. It comes from the juice. So we're after the juice in the cash flow machine. We're after the $4 of juice in the cash flow machine that is available for the time premium. Because what we want to do is we want this graph on our side. We want time to go by, and time is easy, right? Time's going to go by whether we like it or not. Well, time works against you if you're the buyer, and it works for you if you're the seller, because you sell something here and you buy it back at a lower price. And if everything stays the same, that time premium is declining, especially as it gets to expiration. And so things, if you remember, buy low, sell high. This is sell high, but buy low. Everything stays the same. You get to buy it back at 0 time premium, therefore pocketing the juice. So we're going to squeeze all the juice we can out of the options and pocket that time premium, putting it in our wallet, right? Pocketing that juice and putting it in our wallet. That's what the cash flow machine is all about. I hope that made sense. To review, you've got juice plus your protection amount is equal to your time premium. I'm sorry, your price, your premium on your option. Now let me just go through one more thing. We'll talk about this in a minute, but this is your protection amount. So the deeper you go in the money, the more this is protecting you. If the stock goes down, and they do a lot, you want to have a certain degree of protection. So you want to balance that protection. You want to balance the protection against the juice. Now, it's not one for one. It's just a balance. So you want to be able to balance those two things on this seesaw, let's call it. And you want to be able to protect your account, and then you also want to get the juice. We're going to protect this right now with the stock, and then we're going to look to optimize for juice. And now I'm going to just give you a couple of examples and see if now you've got it figured out. If you don't, you can always rewind and watch this module again, or continue going on, and you'll start to catch up as this thing starts to get clear. But you really need to understand this. This is the basics of what we're going to be doing, at least when it comes to how you figure out what options are priced. Now, this is pretty simple. I'm trying to simplify it, but still, there's a lot of new stuff. So when you're learning anything new, it can be confusing. Now, this table basically has 4 examples. And I want you, as we're working on this, to figure out at home or wherever you are, if this is an in-the-money option, an at-the-money option, or an out-of-the-money option, OTM. Okay? So let's start with the first example, and I'll tell you at the end. So write this down so you know your answers. The stock price is now $95. The option is a $90 call. We won't worry about when it expires. It doesn't matter in this example. So it's a $90 call option. The option price is trading for $8.75. That means the intrinsic value is $5 and the juice is $3.75. Is it in the money, at the money, or out of the money? Write your answer down. All right, next one. Stock price, $427. The option is the $4.30 call option. The price of that option is trading at $4.60. Zero intrinsic value, all juice, $4.60 worth of juice, or time premium. Is it in the money, at the money, or out of the money? Write your answer down. Okay. Next one. The stock price is at $232. The option is a $200 strike call. Option price is $40.10. That means there's $32 of intrinsic value and $8.10 worth of juice. In the money, at the money, out of the money. What's your answer? Write it down. And then the final one is the stock is $160. It's the $160 call. It's trading for 70 cents. Obviously, or maybe not obvious, but zero intrinsic value and 70 cents worth of juice. Is it in the money, at the money, out of the money? A little bit of a trick question. Okay, here are your answers. Hopefully you've written them down. Let's talk about them. If you've got a $95 strike price, it's above the stock price, and it's above the $90 strike price, it's $5 in the money. See the intrinsic value? $5, therefore it's in the money. Hopefully you got that. Let's go to the next one. $4.27 is below the strike price. Therefore, it is out of the money. That's why there's zero intrinsic value. There's no value in the money. That's not the intrinsic value can also be known as in the money amount. So there's nothing in the money there. Okay. Stock price is $232. The option is a 200 strike call. That's obviously $32 in the money. See that? $32 of intrinsic value. Therefore, it's in the money. Getting this yet? I hope so. 160, the 160 strike, obviously it's right at the money. So there's zero intrinsic value because it's not above the 160. And therefore, since it's got zero intrinsic value, it is at the money. Or in this case, it's right at it, 160 at the money. Okay, so hopefully now you understand the nomenclature and the vocabulary of options. You understand that they're priced based on supply and demand. You can go to that Options Industry Council and put in any stock and any strike price and any expiration date, and then you can figure out what the value of that stock should or could be, and then start to play around with those numbers. You're going to get a good understanding after you do that for a little bit. You don't have to look at all the other numbers that are below, all the Greeks and all that stuff. Just look at what the price of the stock would be and start to play around and understand in the money, at the money, and out of the money. And then you'll start to understand how we're going to be building this cash flow machine trading system.
Hi, Mark Yagi here, wealth architect and author of this book on my covered call investing system called the Cash Flow Machine. Listen, what you just saw is just one part of creating reliable income of 2 to 4% a month from the stock market. But you know, if it were that easy, then everyone would do it, right? If you want to learn how I create investment income the right way, then you need to learn and have a system with rules and what-if strategies so that you can learn what I do when the market goes against me, what I do when the stock goes against me, how to adjust my trade so that it's always in a winning position, how much to risk, how to build a multi-million-dollar portfolio that creates income of $10,000, $20,000, or $30,000 a month in semi-passive income. And best of all, the whole cash flow machine system takes less than an hour a week to implement. Just go to cashflowmachine.io to learn more, or click this link for more videos, masterclasses, and free resources. See you there.